All right, good evening, guys. Thanks for your patience. Ken at Tortoise Capital. It's the Saturday night podcast for June 20th, 2020. So, the Saturday night podcast is we read the weekend report and we're looking for themes, operational themes that will affect our swing trading all week, tactical trades that we can set up for Monday and which will probably lead to chain trading throughout that day and then, into Tuesday and Wednesday and each day subsequently. We also use this to take a look at strategic ideas that are affecting the longer term conditions. It's not often that significant ones really come to the front. This is one of those weeks, though, that it does. So I'll be spending a little more time on the market classification and market description. I did that Friday night, and it seemed to be important, and it feels even more important now. So we have some of that to look forward to. There was we did a good 2-hour session this afternoon with the hybrid trading guys as part of the weekly question and answer session. It really reinforced for me the importance of the live environment. When I talk through the lessons, it's different when I'm just recording something versus when I know that there's someone listening and asking questions and it's being driven by very specific questions. So there was I felt pretty good integrations that were made, and that video is still processing. It'll get uploaded to the hybrid trading course here tonight. But I think it's worth your attention. There were some real insights into high reliability organizations and how that fits into the way we approach developing a bulletproof investment process. And I'll probably end up talking a little bit about that since that's my current new thing, my new toy. So let's just go ahead and get right into it then. I'm going to try to keep track of the symbols that I want to prepare as we go. See how that goes. So I'm noticing right off the bat that we are in bullish normal conditions. I just noticed that the box didn't fully draw. I must have screwed that up somehow. I added the fourth box on that, and I thought I had pasted it all in. So just real quick, this is what the source file looks like. Yeah, I don't know why that printed that way. So this is how that's going to look now in the future. I broke out the average so that it goes from 80 and above will give us overbought. 50 to 80 will be average plus. 49 to 20 will give us average minus. And then below 20 will give us the oversold. So that breaks out that middle piece just a little bit more. I think it gives us just a little extra piece of insight. I don't know why that didn't print, right? I just noticed it now. So we'll get that sorted. So the 3-day and the 10-day are now below average and weakening. In the market mosaic, we just tipped into bullish at 2.37. The ADX is still a weak and getting weaker trend, so that that bull move off the bottom is really starting to decay. The ATR percentage has moved back up to 2.27%, so that's still a normal reading compared to the last 100 days, but last week this time that was at 1.6 and it had come down from 3.2. So the volatility is starting to increase now. And, last Friday and Monday and Tuesday of this week were large volatility days. So we're starting to see that reflected in the increase of ATR percentage and in the reaction of the risk Z, which you notice there. So the risk index, which is the 30-period moving average of the VIX divided by the 10, with the boundary between risk on and risk off being 1.0, that's now at 0.902, so we are in risk off conditions. That is a vote against swing trading, and it asks you to consider holding less risky assets. When we take that score and look at the last 5,000 trading days and we find the average and standard deviation, that allows us to compute the risk Z, which is how many standard deviations away from average that reading is. And that just tipped into -1, below -1, -1.02. So it just became abnormally worrisome. So Friday's sell-off and the increasing volatility there has now just tipped over into abnormal, and that's an extra vote of unconfidence against those holding riskier assets and swings. The blended monthly rebalancing, you can see what we're holding for June. It's U.S. tech, treasuries in Japan and ETF 13. That feels pretty safe right now. In 22, it's tech, and consumer discretionary, and same with ETF 32. And then you can see the current leaders on the basis of the closing prices on Friday. I added 3 new ETFs to ETF 32. There were 3 slots open, and I've been considering which ones to add. And it turns out that all 3 of the ones that I added are ones that are at the top of the ETF 32. I put Wheaton Precious Metals in there. It's not an ETF, but it acts like one. It is a mix of many different basic and precious metals that are managed by an excellent management company. And it gives something like a blended precious metals commodity fund in a single company ticker. And they're very well managed. And so I just felt that needed to be in there to represent that side of that asset class. PBW is a clean energy, and XOP is a oil and gas exploration ETF. Both of those have been really dominating, as well as Wheaton. So it's just kind of, I've been trading them, and it just seemed like they needed to be in that longer term portfolio exposure. I wish it had done it 3 months ago. And then the leaders in the Dow: Home Depot, Boeing, Chevron, Apple, Microsoft. Apple and Microsoft just continue to get it done, while all of the negative attention to tech giants seems to apply to Amazon, Facebook, Google, to a lesser extent Twitter. Those 2 are now becoming venerables, and Apple and Microsoft are both positioned to really dominate in the next decade, I think. ETF2 remains at 100% exposed. All of the global indexes are still above their 4-month moving average, so that's healthy. This increase in volatility and the little bit of the sell-off hasn't triggered that as an alert yet, but I just believe we're pretty close to that happening. So this is the monthly market health check, and what I want to say about that. Let me get my pen. Let's see if I can get that. So here's the first thing that I'm gonna notice on the monthly basis. I'm just looking for patterns and norms, right? So we've actually had in the last year 2 big sell-off. This one that we're the COVID, and then this one, I forget why that was triggered, but at the time it felt pretty significant. And this sell-off here, sell-off A, sell-off B, we'll just call it that. It took 3 months for that sell-off to fully manifest, from here where it started all the way to the bottom, and then just a little bit of recovery. Then that recovery continued for the next 4 months, and you get this powerful move. And what I want you to notice is that in each month there was a strong finish near the top of the monthly bar, and in each case higher than the opening. After the 4th month, there was about a 50% retracement, and then some muddling through. And then that pause refreshed, and then you got an upward move. So you had a plus, basically a flat period, and then a plus. At the end of this 4-month move, this last month in the sequence initially ran up and then closed poorly. And that was really the first time in this recovery, you notice in every case there were monthly gains until this month. And then the bottom fell out. And that really just lasted, I don't know whether to count that as a selling month or not, but this was a 2-month period in which it went, from 340 to 220. So that was minus $120 on a 340 base, so that's about probably 35%. And then there's been a 3-month recovery. And so this one closed well. This one closed well. This month, however, we're 2/3 or 3/4 of the way through it. And while it started well and zoomed high, there's been a 50% retracement. And now with 10 days left, this thing could easily pull back. And so it just feels like this amazing recovery. I'm really counting the last week or so of this month as part of that. It's almost a 4-month gain. And so my worry is that you had the strong down, a 4-month gain, and then some weakness that we're exactly in that pattern, and that this pattern has already started, and that it's back inside the dragon on a monthly basis. Clean it off. So if we look at the boundary of the dragon right here, we're now back inside this neutral area, whereas up until that point, it was all systems go. Bollinger Band mean here, so there's still, this is still, it's not panic selling yet, but it's certainly an indecision moment. And then you start thinking about the elections and politics and Black Lives Matter and cities on fire and defund police, and the Bolton testimony, the Bolton book given Biden real life. And there's no solutions coming from either party right now. So, and then the Fed has just moved from asset price protection to consumption support. That's a change. This was asset price protection. Consumption support is keeping people alive and keeping the cities from being on fire. So this looked to me like the opportunity really to have recovered from this warning shot. And so Friday, in my core portfolio, which is 20% of my money, and swing portfolio is about 40%. and day trading is about 40%. And this corresponds to strategic, operational, and tactical timeframes. For the last 20 years, this 20% has been 100% invested with matching funds in my 401k and in my Department of Defense TSP, which is a 401k. That's been 100% invested in growth, and so I moved that into 50% cash and 50% treasuries and corporate bonds. So that represents a extreme shift in asset allocation, because I have been using the swings to hedge against any weakness or threat to that, so I could just let this thing continue to grow. But I look at this now that we're in June, and between now and November and the election, where's the good news? There's no good news. There's no good news in there. And so in terms of risk management, I'm taking that strategic risk off the table. I will continue to use my monthly contributions and put that into equities, which form the base of this. But that entire pile is now moving to a different risk category. I am not doing much swing trading right now because of the risk Z and the market condition. So my real activity is centered here. And I just think that's probably the pattern going forward all the way to November. Now, it could be that market conditions are really going to improve, and it could either be, hey, if this thing starts running south again, then I'll be a swing trader on the short side, and then a swing trader on the long side if it rebounds again. But while it's in this neutral zone, I'm not doing any swing trading, because the possibility of these sharp reversals, that's kryptonite to swing trades. So I will be maximizing the intraday volatility and really working those katas for the intraday trades. So that's a strategic commentary on asset allocation. Now, your mileage may vary and your risk profile is going to be different than mine. I'm 62. I get 3 kids in college. I'm the oldest member of my generation in our extended family, so I'm responsible for the tribe. And I've got exposure to other growth opportunities. But in my position right there, that's a risk I don't have to take, and that's a risk that I won't take. I'm not going to let Biden and the orange-skinned baboon put the family nest egg at risk for their tactical shenanigans. So that's just not going to happen. So I'm perfectly willing to live with that. So on Patreon, I posted a link. It may have been Betty sent that to me. That was talking about, I think it's the Wolf of Wall Street, and he was talking about why he went short the market, and all of the things that he listed were things that we'd been talking about. And it was just funny that came out at the same, within minutes of me making my tactical decision making or my strategic decision making. So we'll see how that goes. It just sharpens the tool. So that's what I'm reading from the monthly. So on the weekly, this had a lot to do with that decision too, as I was preparing charts and looking at, the daily updates and whatnot. On the weekly charts, I just feel that V bottom which is the least likely kind of price action you see in the big indexes. It's very rare. But you got this huge downward move, and then basically a V bottom. And then the last 3 weeks, there has just not been that same kind of powerful up move. This just feels like a separate condition. So while this week was a real expansion, featuring a really big gap up on the basis of some Fed announcements that they were going to be buying those corporate bonds, then there was almost as quickly a haircut of that. It brought it all the way back to the weekly Bollinger Band mean, and a gap down, a recovery, but then a weak sell-off. So it is within 3%. This little band right in here is the width of the dragon. That's 3%, and it's only 1% away from the key price level of 300. So if this thing starts failing and cracks through 300, then that means the dragon fails, and now it's down, to the edge of the river, and then even here. Then the belly of the dragon has got a hold, and then we're already back to 260. So that would be a $60 haircut on 300. That's a 20% sell-off, and that would be half of all of this recovery. So just a retracement back to here would not be unusual. Find support and then continue. But I'm not going to take a 20% haircut on my core strategic positions that have just had this, maybe that's the best 50-day performance ever, on the basis of the Fed printing 14 or 15 trillion. They're not going to do that again. China's making noise about undercutting the dollar as the currency of record. So it just seemed to me that this was the time to change my risk profile. So that's what I'm seeing on the weekly. Very risky business. Ice starting to crack. On the daily, I covered this on Friday, but this last little bit of selling pressure here on Friday in that area, that was, an orderly 3-day sell-off, gap, and then crash. And so it's here like at 308. That's like 2.5% to this very key support level right at 300 at 302 in the Bollinger Band mean. That's actually like 2% buffer. And we just saw that the ATR percentage is 2.2. That's 1 day of price action. And if that breaches, it's back to fair value. And then here's, the all important 300, which is fair value. That's 2 ATRs away. And if that cracks, then that means this entire summer run all the way up could disappear in one strong day to the downside. So this looked like, when I made my decisions here late Thursday night, that was the opportunity to make those changes Friday morning. And so that allows me to have enjoyed probably 3/4 of that run on the way up. So you listen to Friday nights if you want to hear more of that discussion. I wanted to resurrect the 30-minute one because I now want to get tactical because I'm spending more time now on the tactics. Every one of these yellow dots is kind of like an important pricing level, right? So here's and I want to show this big thick red line right here is right at that key price level of 300, which we saw was the Bollinger Band mean on the daily. That was the base from which this last move from 300 to 324 occurred, which was a plus 8%. And then it gets these two chunks, then a gap up and one final chunk. This is a really important price pattern when you're on any time frame, but on the 30s it's instructive. You have lower highs, you have lower lows, and that's true for the hump of the dragon and the RL10s. And then you notice that summer rolled into fall and then became winter right in here. That's your tell. Now, you had to have taken that position if you wanted, otherwise you missed that gap. But even if you waited for that, this gap down and sell off, it's already a 50% retracement and failing. You know, that's half of the previous gain. And then even with that, notice the authority and the conviction of the selling on 30-minute bars. You'll notice that the corresponding rise is much more stair step. So it's climbing up the stairs, falling out the window. And that's why the collapsing dragon is the preferred pattern. You'll notice that this selling pressure that started in here was basically when this support level over in here collapsed, didn't hold. If that was going to be a strong support, they'd have been buying it from that critical state, like they did over here. They gapped and then it rose. But no, instead it was a strong vote down. Held support here, where it held support over here, and then that triggered a gain. That's your supported spring crossing. Then a nice run up. But now notice it doesn't get that third leg. That's the dog that didn't bark. That held support right where it held support last time. On the previous leg up, this made the run. This time it failed. That's an important tell. Another collapsing dragon in here. And now it's only this much buffer. That's about 1%. 1%. And then if that fails, look out below. That will have negated both of these strong moves up. Notice how that each move is getting smaller. Each piece of buying pressure has less and less conviction. So at the first, if this thing starts selling on Monday, I want to try to get my position in here so that if this breaks, I expect that to go fast to here. And then if that breaks, I want to have essentially 3 positions short by the time it were to break through 300. So the 30-minute is this transitional time frame for me in between the intraday tactical of 1-minute charts and then the swing trade intervals of 2-hour and daily charts. Just as I was looking at this one, the geometry of this and the relative power of the traders to move it in those kind of standard chunks, 1, 2, 3. That's what a burst looks like, or a leg looks like. So we're looking at the BMRs now. Tech was still pretty strong. Emerging markets, Japan, as alternatives to the U.S. Looks like some of the bloom has gone off the lily here in Latin America, and yeah, not much to choose from in there. On the ETF 22, it's tech is the last hope there inside the U.S. Healthcare finally showed a little bit of recovery with a nice 3% gain. It's had a bad month and a below average longer term. So I'm just hoping for their sake that that's starting to show some strength. Wheat and precious metals, the defensive play. There's our three little superstars. So they've had some amazing gains on the long term. Look, this is why XOP is just so darn interesting. When it's horrible, and it's like a leveraged energy sector because you notice the next one up is XLE, and XOP gains better, loses about the same. They both gave back this week, but you can see that XOP has been if you're going to trade energy, you might as well be looking at XOP. Right? Nice rebound in the defensive play. So this loss over the last month in Wheaton is what was fueling, that last run up in the equities. But now this is evidence of some defensive plays happening. So that one, and then healthcare, which is a value play right now. And Brazil's little moment in the sun is probably over. Didn't really sustain that monthly momentum into the weekly. So that was probably just an extreme value kind of a play. And that move is probably done. In the Dow 30, that strength in healthcare we see reflected here in Merck and Walgreens. But not much else to choose from. And then, the reason for those tactical plays, U.S. Steel, which has been up 65% over 3 months, but down 40% on a 6 month, was down 15% this week. I mean, that's a steel company. That is trading with some volatility that you can get behind. So that's why it's a preferred trading target of mine. But man, I am really emphasizing the intraday trade on that one. And that's why. Sector spiders looks like biotech and healthcare. No change there. ETF Max. Technology seems to be there's social media index, biotech, software and services, computing index, semis. So it's all tech all the time. So you can find different ways to slice and dice that. The easiest is probably just XLK. In the ETF regional report, this is for the first time in a long time. Mid caps have now replaced the large caps inside the U.S. strength. So the S&P had been the strongest behind tech, but now mid caps have eclipsed it on the strength. So a little bit of weakness coming into the S&P, but the S&P at 70 is still better than EFA at 63. So it's still The U.S. is the strong story. Japan and Latin America the weakest. Although Japan has been consistent, just hasn't been much growth there. It's tech and discretionary. And you can see that energy has rebounded nicely after the crush of oil prices. When you look at the other asset classes, really, there's just nothing better than equities right now, but even those opportunities are starting to dry up when you compare it to these other asset classes over here. Yeah, not much to choose from. Let's see, we're looking at XOP is still interesting, extremely volatile, and that's why that quality is in the red at 38. That's just the quality. I don't talk about it that much, but that's a 40-week system quality number. So it's a blend between gains and volatility. So XOP has had nice gains, but it has been so extraordinarily volatile. Its quality rating is low as a long-term buy and hold. So it's much more suitable for tactical trading, as is energy in that sense, XLE. But if you're going to trade energy, you might as well be up here in XOP. You just get better performance. Consumer discretionary, XLY is nice because that is green and white. And so when I come up here and check green and white, it was good. Now it's great. So this is an opportunity to exploit new strength. It can be turbo traded, right? Because it has plenty of volume. And this represents new leadership. And then also you get that in the growth index, silver in Germany. They are all green and white also. Home construction, pretty interesting, green and white, ITB. You wouldn't have thunk that, would you? Now of all times. I'm going to go take a look at ITB. I haven't looked at that one in a long time. And that means I also want to look at cut because you need lumber to build houses. This one just gives you an idea of which are the liquid tradables. So EWZ is still of interest. It's in the top 30 for daily dollar volume and has the kind of intraday volatility that you like. So energy is in that category as well. Gold miners is probably good too. And finance, because that has some pretty good volatility. People have been buying the heck out of corporates, high yield corporate bonds. Man, that's number 3 or number 4 in terms of daily dollar volume. Man, I haven't seen that for a long time. That's got to be a response to the Feds buying them as well. That's probably one I want to go look at. HYG. I may be able to do something in that core portfolio since I put it just quickly. I just moved it into cash and treasuries. That a broad array of corporate high yield, that might be something to look at. I'll look at that. Maybe get the better stream of income on that. HYG. Okay. So now, way down here at the bottom of the stack, those things in the red, from good, from deep, um, deep in the red comes potential for great value. Mostly it's those treasuries and bond funds. Not surprising. So yeah, okay. Shift into the daily now. And we've seen that one already. And we've seen most of this too. I'm just noticing now that the 10-day max pains, those are the ones that the furthest percentage away from their 10-day high, but are also postured possibly to get crushed because of their weakness so far. So Boeing, ExxonMobil, that whole finance sector. Simon, and then among the S&P 100, Simon Property Group. I'll be ready on that one on the short side. That's a frog champion, good in both directions. So I want to go make sure that I really look at that one close. SPG. Yeah. Daily tactical summary. A couple dojis in there, Travelers and Pfizer. A couple RSI 2s there. That's McDonald's and Nike of interest. Nothing else really jumps out at me. I'll come over and look at the auto framer now. Travelers at 4-1, Pfizer at 4-1, and a doji. So that makes a couple reasons to want to look at Pfizer. Healthcare is good. Pfizer's a doji, has a great reward to risk ratio. That's going to be one that I go look at. In the ETFs, just one doji in healthcare, XLV. So I'm going to look at that one, make sure I look at that one as part of the healthcare Pfizer. I'm just going to go ahead and put Merck and J&J on there too. And just refresh my view of those. Silver was a big winner on Friday, so that's just, I've got to be really good on Wheaton. If you didn't listen to the Friday night podcast, you probably ought to, and just take a look at Ken's 30-hour day on that one. Just marvelous work by his part. Utilities. I saw some charts that suggested that as a possible intraday trader. For the longest while, I haven't looked at it. I just felt like the daily range was so small that I couldn't really trade it. But that, like A-Shock showed me, I think it's tradable with the supported spring crossing. So I'm going to go look at that one and maybe change my mind. That's about every. Mexico had a really nice move. It was much different than anything else. It was up 3%. That was such an anomaly that is there some follow through, or was that just the tallest nail that's going to get hammered back down on Monday? Don't know, but it's going to be starting with a turbo and a hybrid frog, but that's going to move right to the top of my list. Mexico. Pinch and stretch. Pfizer and Walmart. That's another reason to love Pfizer, that it's the furthest out of its river at a minus 1.22 z-score. I like way over here on the most compressed pinch box is Treasuries. That has a really nice tight range here lately, so that'll be of interest. In the auto framer, just a ton of things that could be looked at. So I am going to look right off the bat at some favorites right there at the top. There's Pfizer and Brazil and XOP. I love that. That's telling me that if, despite all of my negative feelings, this pullback here might have given them room to really expand another leg up. So I could be tempted on that depending on how the Monday trade shapes out. So I'm already going to look at those. I'm just going to reinforce XOP over here. But Pfizer is clearly a champ in here that I want to look at. And do I have Brazil on there? I want to give Brazil extra special attention. I mean, I can't give it more attention than I already give it, but I will. On the regression line fractals, top shelf are the ones that are the deeply discounted. I see Walmart, Intel of interest. I guess it's time to look at Walmart again. See how that's doing. In the red on the bottom shelf, the most number of ATRs above their RL270. So these are relative strength leaders. Apple, Microsoft. I'm going to make sure I look at those two charts. 17. United Health and Costco on the daily squeezes. Nothing extra to see on that. Just about everything is in the fall on the Four Seasons of MACD. I'll wait for that to come up on your screen. But in the Four Seasons of MACD, just about everything is in the fall. So therefore, the things that are in the green of the summer are very interesting. Oh, look, Microsoft, Apple, Amazon. Yeah, that's where the strength is. Treasuries in the spring and starting to make some gains. Since I just put a chunk of money into those, maybe I ought to go look at that. In the NDX summary, Microsoft, Apple, Procter, and the in the strongest portion of the NDX 10, U.S. Steel, just man, that down 15%. That's just got to move right to the top of my stack too. Then on the ETF side, gold, treasuries. So that means Wheaton's going to be interesting. Yeah, so WPM. XLU, I think, do I have it? Yeah, at minus 88 on the 3-day NDX. Man, what a smash that was. So if you want to buy some kind of equity exposure and get some yield, I mean, aren't you buying utilities? That's better than that's a public utility bond, right? Are we gonna turn off electricity? No, we're not. We're not gonna turn off electricity. So maybe XLU has some opportunities there. In the market, I'll spend a little more time on this one. I haven't much in previous sessions, but when the strategic posture changes, then maybe we should spend more time. So there's on chart number 1, there's 2 regression lines. There's the blue straight line. That's the 30-period regression line. The slope of that is what gives us the slope statistic, right? This black one is a what's the name? It's an algebraic regression line, polynomial regression. So that sort of weights the front end of that and gives you sort of a almost like a weighted regression line. So it doesn't treat them all as equal data points. It kind of divides it into thirds and then weights this one a little bit stronger. So you actually see a bend in that one. And when it crosses below, that's giving you a warning that there's some weakness coming in. We already know that when we look at the slope statistic over here, this thing got to +1 and then crossed itself and is coming back. That's a foreshadowing of weakness. You see that weakness over here in the stretch above the 200. It got almost to 1 standard deviation and has rolled over. When that thing starts rolling over, I kind of always worry about that. And this really has had 2 roll over. It was a peak, then a rebound, and then that was a lower high. And now this one, this was a moment of weakness. That was that first leg up out of this big sell-off down here. Started right here. These times line up. And then this nice, great big move here corresponds to the improvement in the slope statistic. So you can see that on a 30-day basis, the slope was way down and then it got way up. And then it started to stall out a little bit here. And so it came back into normal. But now when it peaks at a lower level, but it was still at +1 and now it started to roll over, that's a foreshadowing of weakness all the way back in here. So that was another reason for me to be concerned about a sea change, that the tide is starting to roll out. All part of the market mosaic here. Looking at the slope statistic now over the last 10 years, and then looking at some measures of volatility. The extreme volatility is measured by ATR percentage. Look at that, 33 days ago, that ATR percentage was 8%. And so the 100-day average was 3%. And this thing got down as low as 1.6. And so, yeah, a lot of that volatility came out of the market by any measure of volatility. And that was responsible for this grinding upward gains. The slope stat got better. But now we're starting to see a return of volatility in that measure and then in the 30-day, the size of the frog box, essentially. So that just says that more downside has become available here recently. This will be the last chart I think we look at today. So this entire move was outside of the river all the way down. Leg 1, leg 2, leg 3, and now at 50% pullback, and now it's inside the river, and then this peak and that peak, this thing rolling down. So this is like at 300. This support level here is 300. So if that cracks, then it's down here to the southern edge of the river at 280. You know, and that's an 8% move. So I don't want to be exposed to that, to those sell-offs. And that was part of the reason to take my risk at age 62, that chunk off the table. Again, your mileage may vary. Now, in my kids' 401ks, I still got them in all equities. They got a 40-year time horizon. So that's still the Rip Van Winkle trade for them. Yeah, that's all I want to look at. So I've got my list of symbols that I want to take a look at as I review, special cases. I definitely like U.S. Steel Mexico, Brazil, Pfizer. That really sticks with me. I'm going to look at that XLV Pharmaceuticals as part of that whole cluster. I'm going to just come down here and make that XLV, PFE, Merck, Johnson & Johnson as a logic chain. I guess I'm going to add XLB, US Steel, Alcoa, Nucor as part of that whole chain. Wheaton and XOP and that energy, and then the defensive plays, and then treasuries. I guess got to do that too. So that's the ones that really jump out at me as special attention to those. Yeah. So I'm going to work on those charts tonight and do my little trade frames and prep. You've had a chance to listen to me mumble and mosey my way through that salad bar looking for different themes. As I go starting to look at those high priority payoffs, some other things may occur to me, but those are going to be the main lines of focus. So the plan is a very broad-based view. I looked at strategic, operational, and tactical, but that's all, and I have a certain directional bias to the downside right now, but I'm also mindful of volatility on the increase can work to the upside as well. So I'm going to be framing trades in both directions. And so as I mentioned this today, I start off by creating a directional bias with MACD histogram and the 4 seasons. But by the time I work my way through the trade frames, I have eliminated directional bias because I've defined very precise trigger points to go long or short these targets based on which way price starts working out. So directional bias starts off being very important, so I can at least account for that. But then the systematic nature of trade framing that trade causes me to protect against that bias by looking at the other side of the trade thoroughly. And then I can go in with price levels and no emotional commitment to one direction or the other. So that's what I want to say about that. So that's a good quick hour. If you want me to comment on your trade frames, post a couple in the chat room, and that will be the basis for tomorrow night's podcast. And I'll get this processed and hung. The other one is processed and is now, from this afternoon's Q&A session, that'll get posted. And then the hybrid trading course will be updated with links to those in course number 104. Okay. So thanks a lot for your kind attention, guys. We will see you tomorrow, and have a good Father's Day. We're going to be eating some Kansas City barbecue. All the kids are home, so we're going to go play on the Switch. I'm going to watch them play. I can't keep up with them. My digital eye-hand coordination is laughable compared to them. So, got some work to do. Take good care, guys. We will see you tomorrow.